Thank you so much, members of the public. We are really sorry that we got in a little late due to some technical challenges, but our technicians have been good enough to fix it. It's another wonderful day, and God has blessed us to have a wonderful guest with us, a financial specialist and a technician in that space, Mr. Alfred Mathu. Welcome.
Thank you very much.
Yes, this is the RIBA SASA show, home of organic conversations, and where we try to educate our audience about the happenings and a lot of things that can actually benefit their lives.
Thank you very much. I'm very excited to be here.
Absolutely. Thank you. Yes. So now you are a financial expert.
Yeah.
Tell us just what that does. What does that all entails?
Ladies and gentlemen, my name is Alfred Mathu. I'm a financial doctor, and I run an agency called HISA Africa Insurance Agency, where I'm the founder and chief executive. HISA Africa, we pride ourselves in helping people that are financially sick to go through the recovery process.
Sure.
The Kenyan men and women are, in general, to the greater extent, financially sick. Yes. So our role is to help people understand where they are on their financial journey, be able to understand the finer details of the financial sickness, and to help them make best steps to be able to get them to recovery, and of course, be able to achieve their long-term, medium, and short-term financial agenda.
Okay. Wow, that's well put. Yes. So what does a financial discipline look like to you?
Let me start by saying what financial planning is all about, because that's a bigger subject in financial planning. When you talk about financial planning, ladies and gentlemen, this is simply the ability to manage your financial resources in order to achieve your various goals and aspirations. When you start working, you'll start a relationship with money. Right from the onset, you need to build a good relationship with money. Because one of the things that we want to pick as we carry on with the conversation, money is very unforgetful. It doesn't forget, neither does it forgive. If you build a bad relationship with it, and you do that by overspending, going into careless spending, going to major lifestyle spending, going into impulse spending, when you do that, you will get into a very bad relationship with your money, and at the point that you've been needing it most, you'll most likely not have it on your way. Okay. So when it comes to financial planning, financial stability, I always say, is not about how much money you're going to be earning, but it's about having correct structures that give your money identity and direction. Money does not respect where you come from, does not respect your age, does not respect your profession. Money respects structures. You will learn again as we go on that some of the structures that you may want to prioritize in your financial journey would include such instruments as budgeting. When you talk about emergency funding, when you talk about succession planning, these are some of the most important, very critical financial structures that will help to give your money identity and direction. You have to be the one intentionally assigning your money responsibilities. And you learn again that some of the responsibilities that you want to give your money would include maybe emergency funding. We talk about education of children for those that have children. We talk about wealth accumulation. We talk about wealth diversification. We talk about wealth protection. We talk about retirement planning. We talk about lifestyle management. We talk about black tax. All these are assignments that you can easily give your money. And I want to say here that those people that are earning the most are not necessarily the richest in the world. The ones that are richest in the world are those that have connected with the why they earn. The why is the most important part of this financial conversation. Money remains the tool. The purpose is the master.
Yeah, because many I think even myself, I think I've been in that cycle for quite a while, whereby we find that many earn a lot, but still continue to struggle. I don't know how you explain that.
Let me tell you, there are many reasons why people are financially sick. And to be very, very precise, approximately 97% of Kenyans are financially sick. These are guys that are headed to their future without clarity of anything. They don't have structures. They don't have budgets. They don't have goals. They make money spend. A lot of them are living above means. Some of them spend way more than they earn. And these are guys who, at the finish line, will be very disappointed. Because while they had a very, very good productive life, they will not be able to sustain it in old age. So what I want to say here is that one of the reasons why people are sick, it is because they do not have structures that give money the direction. When money hits your bank account, who directs it where to go? Is it you or is it expenses? For a lot of people, when money hits a bank account, you sit back comfortably and allow the expenses to take over.
Yes.
Where expenses take over, we will never have any room for investments and savings. Everything will go into lifestyle, everything will go into expenses.
Yes.
And a lot of the expenses that we're talking about here are unnecessary expenses. They are things that you're not even going to sustain in the future. So what I want to say then is that we got about 4 money personalities. And depending on how you relate with your money, you could fall in any of these 4 personalities. The first character is called a spender.
A spender.
Spender. This is a person that goes for instant gratification. When the money hits the bank account, they want to look at how can they make themselves happy now. They are party animals. They use borrowed money to even fund lifestyles and show-offs. They are guys who are always eating out. They are always going for designer products. For them, it's about now, not about tomorrow. They will always spend more than 25% of their regular income on lifestyle.
Yes.
These guys will not be able to leave room for any savings and investments. And I always say that for people who are disciplined or people who have been in that mess and want to turn around, the first thing is to allow themselves to use a budget whenever it comes to spending. A budget is a revolutionary financial planning tool that gives your money direction. I've talked about a budget formula called 25-50-25. And one of the wealthiest gentlemen on earth called Warren Buffett says that we should be spending the balance of investment. When you make money, the first 25% of your income, let it go into savings and investment. The next portion of 50% will go to your essential expenses, call them the needs. The remaining 25% will go to lifestyle expenses. And this is where people disconnect with their discipline. Because when money comes in, unless you are very intentional in deciding what portion goes where, then you can be sure that your financial status will never have an upward trajectory. Now, the second character is a character that we call a saver.
A saver.
Yes. These are people who, when they have money, they leave this money lying in savings account, the bank accounts. That money is doing nothing, it's just sleeping there.
As long as they've saved for them,
they're happy with their
satisfied.
bank balances. They're happy to always go to the ATM and put the mini statement and see that my bank balance is still accurate.
Yes.
That money is sleeping there nicely.
Yes.
The banks will make use of that money, trade with it, make value for the bank, but never make anything for you who left the money in that account. We always say that if you are leaving more than 20% of the savings and investment component in a bank account, then you are a saver. And the tragedy with that is that when you are growing older, your money is not. The 1 million shillings that you left will always be. It will never be more. So it will never sustain what you wanted to sustain in the future.
Might even be less because of
Or
the
even less
factor
because of the bank charges.
and the inflation. So
Yes.
Yes.
Now, I talk about that character, and a very interesting character called a dreamer. These are people who start and end their financial planning in the dreaming. They never take the first step. They are always procrastinating. What they said last year, they're going to say it this year, they're going to say it next year.
Yes.
They'll never take any step forward.
Yes.
For these people, if you're having more than 50% of your financial goals either not started or completed within the calendar year, you are a dreamer. The procrastinators. And they have procrastinated until they lost the time, they lost the opportunity, they lost the resources. Procrastination is like trying to fatten a cow on the market day. You had enough time to fatten the cow. You chose to wait. Now on the 9th hour, you are trying to overfeed the cow for value. Instead of getting value, you get less. Let me talk about the final character and the most, of course, where all of us desire to be, the investor.
Okay.
An investor is not defined by their bank balances. My brother, having 10 million shillings in your bank account does not confirm you to be an investor. Having 50 million shillings in your bank account does not confirm you to be an investor. Having a negative balance does not confirm that you're not an investor. An investor is defined by the way they relate and socialize with their money. They're very long term with their planning. They don't allow procrastination. They're committed to the investment agenda. They normally write down their goals and work with accountability partners. You are always deemed to be an investor. If
They
you're
work with
investing a
accountability
minimum-
balance.
Okay. So let me finish the point that I was saying. You are deemed to be an investor if you're investing a minimum of 25% of your regular income.
Okay.
Now, ask a question about the accountability. You asked a question.
Yes.
What were you asking about the accountability?
Okay. I was asking that. I think my line
Is it
of thought.
accountability partner? Accountability partner.
Yes.
Now, let me tell you.
Yes.
In this life, you can't know everything. You need somebody who help you to maintain sanity. That if these are the 5 goals that you've said you want to accomplish this year, a lot of times, and especially with the men, keep digressing.
Yes.
You wanted to do this,
Yes.
but you're not doing a different thing.
Okay.
So that accountability partner is one who understands your financial story inside out. And that anytime you're about to digress, they'll tell you, hold on, my brother. You said that you wanted to clear your mortgage this year.
Yes.
Why are you now going into buying RAD, which was not part of the goals? That guy helps you to remain sober. That guy helps you to stick to the goals that you had talked about. That accountability partner is very important.
Very
But
important.
now we have a problem in our country. Trust levels. People are not able to trust each other. I want to share with you my goals, but how sure I am that that my information remain confidential. So you end up not having an accountability partner. And the
Yes.
problem with that is that when you make a brander, you will not know until you have completely messed up. If you had an accountability partner,
Yes.
that person would have actually talked to you before getting deep in the mess.
Yes.
But as I've said, a lot of people are operating without them because of trust.
Yes.
Yes.
Oh, okay. So, you see, in our culture today, you will find like another reason as why people don't have that accountability partner is because of the fear of superstition. That you share something with somebody, then they take that info.
That's what I'm saying. It's a trust. It's purely about trust. It's purely about trust. Yes, but where are you able to get somebody that is stable and sober and who understands where you are going and they're willing to help you genuinely to achieve? Then your direction is actually going to be more accomplished.
Oh, okay. So no, sometimes we look at a person who was already into a lot of liabilities, a lot of loans left, right, and center, calls left, right, and center. When this person comes to you for help in that space, because the basic solution that they're looking for is some new money, how realistic is the financial advice in such kind of a case?
Okay, I'll tell you, my brother, an ideal financial planning roadmap has got steps. And there are basically 4 steps in an ideal financial planning roadmap. The first step is to accumulate money. The second step is to grow the money. The third step, sustain the money. And of course, protect it. And then finally distribute it. Now, I want to talk briefly about each of these steps.
Yes.
In terms of accumulation,
Yes.
you want to ensure that at all stages from your various hustles, that what comes into your bank account is more than what leaves. And so that over time, you start retaining some money. That which you are retaining, ensure that you accumulate it.
Okay.
And as you accumulate it, don't accumulate it in the bank. Can you direct it into an environment where it can appreciate over time? That's an investment environment. Then the 1 million shillings that you've been able to accumulate, you don't just let it lie in the bank account. Direct it into an investment program where it will start appreciating over time. And of course, as you do that, ensure again you're not putting the entire portfolio in one basket. Diversify the scope. Diversify. By diversifying, you reduce the risks that you're exposed to. And you ensure that you have multiple income streams. In the third step, would ensure that which you have made, accumulated, and diversified, can you protect it? There are enough risks on our financial journey. Some of the risks can be managed. Others you may not be able to manage. Let's talk about some of the risks and what you can do. For example, death, disability, and critical illness. When it comes to death, just have a life cover. Because there's some certain financial obligations that you are currently undertaking. That in your absence, a benefit is going to be paid out to the dependents so that they can carry on with the investment agenda that you had. We don't want a collapse of the structure and because you're not there. The second element is about critical illness. That you need to have a critical illness cover. That if you are diagnosed with a terminal illness, that you will not have to deplete your portfolio while paying bills in the hospital. Why don't you have a separate independent option that takes care of the medical bills or the critical illness bills? And then the other one is disability. To realize that if your ability to work and generate more is disrupted, you then need a cushion. And a cushion would generally be a disability coverage. So that takes care of the protection. That you do not deplete your portfolio or handling risks. The next step is now to sustain that which you have put. You do not want a scenario where you are wealthy 2 years and then broke the subsequent years. You need to sustain your wealth. A lot of people have had a very short stint with wealth. That you are doing very well last year, but one. But now you are doing so badly.
Yeah,
You're not
I've
able to
seen that.
sustain. You need to come up with mechanisms of sustaining your wealth. Ensuring that wherever that you are directing your wealth is well structured. You've got the right structures in place. If it's about succession, if it's about risk management, if it's about diversification, have the structure that help you in the sustenance. Then finally is the distribution. Distribution is what other people call succession planning. You need to come up with a legitimate mechanism of transferring wealth from yourself to your dependents when the time comes. A lot of people, unfortunately, die intestate. 99-point-something% of Kenyans don't have a will. They don't have a trust in place. It is on their departure from this world that family members are invited to come and discuss succession. The neighbors are invited. Church members are invited. Unfortunately, some of these people may never have the best interest of your dependents.
Absolutely.
So you have to be very intentional in this particular journey. So when I'm talking about debts, right from the onset, I've realized that a lot of people borrow money not for investments, but for lifestyle management and consumption.
Yes.
And I want to tell you something. The Bible, for those who read the Bible, is very clear on the issue of debts.
Yes.
The one who borrows becomes a slave of the one who lends.
Yeah.
The moment you have a debt, you will never operate in your terms. You will always operate in the terms of the one who gave you the money.
That is
so
true.
If you do not want to get into financial slavery, can you stay debt free? And where you have to take a debt, can you let it be for investment purposes? But if you are then in a quagmire of debts, can we talk about a few ideas of getting you out of the mess? The first idea, when you are repaying your debts, can you prioritize the most expensive? Different organizations will charge different rates of interest against the debt.
That is true.
If you have one charging 15, another one charging 10, prioritize this one of 15 because it will otherwise eat away all your savings and investments. That's point number one. Point number two, if you're in multiple debts, consolidate. You got a loan with Stanchart, a loan with ABSA, a loan with Cooperative Bank, and a loan with Yosako. Can you consolidate all these debts and be left dealing with one lender? If you can go and negotiate your case with ABSA Bank, and they agree to buy all the other debts, it will be a lot better and more convenient for you to deal with one lender than to deal with three. And I remember what happened during COVID, and some people were telling me, where people had multiple debts, every bank wanted you to prioritize their debt repayment.
That's true.
So assuming that you're working on a very limited cash flow, each bank is subjecting you to pressure.
Yeah.
Can you imagine now if you had your debts consolidated,
Then
you're able to renegotiate the terms, even to have extension of that loan. But if you're in multiple banks, you realize that now the pressure and strain is so much, you're not even able to pay. Now, let me talk about that element. It is why we talk about you have to ensure that you use a budget all the time.
Okay.
A budget naturally helps you to cut off some of the necessary expenses. A budget will help you to reduce your spending appetite. That when you do whatever you need to do, it will be well structured.
Okay, you will ask the question.
Whatever you do, it will put into consideration your disposable income.
Yes.
You get?
Yes.
Then I also always talk about this diversification. We have had situations where people are well invested, but they invested in only one asset class. Let's, for example, say those that keep buying land.
Okay.
Now, a situation has come where cash is needed, and all your money is stuck in a solid asset. Call this rand, chunks of rand all over the place, plots all over the place. You are trying to dispose the rand to get cash for the emergency.
Yes. Hardly can you be able to get it in a day.
Like right now, the appetite for rand has significantly reduced.
Yes.
So if you are here struggling to sell off a piece of rand so that you can have cash for meeting some of your obligations, you might get yourself in a very tight spot. Why don't you diversify the scope of your investment so that in the event cash is needed, you have multiple options that you can get the cash from, whichever gives the cash faster.
Yeah, sure. That is true.
That's another idea. If you are sitting on a portfolio of dead assets, dispose them. Dispose those dead assets.
Which are those dead assets?
Some of the plots that people are keeping. You bought this plot 5 years ago. The brokers keep telling you that it's appreciating. But in real time, if you attempt selling it, the offers you're getting are more than the price you bought. So dead assets, they're not taking you anywhere.
Yeah,
a lot of people are very happy to have title deeds in their house. But what's the value of title deed if it cannot be able to meet your financial situation at
yes,
the point of
even
emergency?
your immediate financial needs.
Dispose the unnecessary rand that you have. Pay off the debts.
Yes.
Pay off the debt. So these are some of the strategies that people should try to use when they're in a debt position. But I think for me, by and large, it is important that before you can take a debt, interrogate the need of that debt. If it is actually coming for lifestyle and for consumption, don't take that debt. It will put you in a worse position. Because all debts will come with interest. And a lot of people are in serious financial quagmires because of those debts. Most of the interest that you're charged, a lot of times it organizes your financial structure. You're not going to be able to build more. You focus on repaying a debt the next 5 years. By the time you are done, you're nearly getting to retirement.
That is true.
Yeah.
Okay, so there is this budgeting that you keep talking about. Maybe you can just take us through what this budgeting is all about and how also realistic it is for that little man to do the budgeting, because there's a perception that majority of those people who actually concentrate in doing the budgets, probably the affluent and the elite people in such and some form of neighborhood, and who has a bigger kind of disposable income as opposed to people from the low class.
No, as I've said from the beginning, and I said 97% of Kenyans are financially sick. If you look at the reasons why most of the people are financially sick, top in that list is people spending without a budget. That money hits the bank account, and you don't have an instrument that directs where that money will go.
So it doesn't matter.
Are the ones directing.
Oh, okay.
The moment you allow a budget, everything else will change. Now, let me talk briefly about a budget.
Yes.
And I've earlier said that a gentleman called Warren Buffett,
who is
one of the wealthiest on earth, says that you should be spending the balance of investment. When you make money, the first 25% of your income should be for savings and investment. The next portion of your income, 50%, should go to your needs.
Yes.
And the remaining 25% will go to your lifestyle. That gives us a budget formula called 25, 50, 25. This first 25% of your regular income will go into your savings and investment, depending on your money personality. The first 20% of the 25 will go to emergency funding. This is why you direct your money to an emergency account, an account that you can be able to access that money easily, all the time, and the money is safe in that particular instrument. We talk about money markets in Kenya. Ensure to build a cushion of 3 to 6 times of your monthly financial requirements in a space that you can access the money all the time and is safe all the time.
Yes.
That's the money market space. Let me go to the second element. 50% of the 25 will go to your medium-term goals.
Okay.
At the medium term, I'm looking at goals that you must accomplish in the next 5 years minimum, but by your age of 50. And I want to be very clear on that. That medium-term goals,
yes,
I'm looking at goals that you must accomplish in the next 5 years minimum, but by your age of 50. Which tells you, if you're above 45, the medium-term conversation is not your conversation. This conversation is for those that are below 45.
Below 45?
Yes. At the medium term,
yes,
you must ensure that you work with the budget to the extent that what comes in, you focus on what must you do in these 5 years, but by your age of 50. For example, you want to buy a house. Let's say this guy is 30 years and wants to buy a house. Buying a house needs you to have a lump sum. A lot of times people are not earning lump sums. They're earning installments. And by the way, you'll be asking, what is a lump sum? Anything that is below 999,000 is considered an installment. Anything above 999,000 is a lump sum. So the bulk of people don't earn lump
so
sums.
anything above, $1 million above, that's a lump sum.
Correct, yes. Anything above $1 million is a lump sum. Below $1 million is an installment. And about 99% of people are earning those installments.
Yes.
Okay? Now, for you to be able to get a lump sum from installment, the only way is disciplined contractual investment.
Yeah, yes, sure.
Where we say that, I can't be able to buy a house right now, but I can start putting funds together now so that in the next 5 years I buy the house.
Yes.
This is what we're calling the contractual medium-term goal. Let's talk about those that have children. You got a child who is 5 years old. A 5-year-old child is going to university in the next 13 years approximately. You'll need money for that education. You do not have to wait until the last minute for you to start looking for the school fees, which is what parents in Kenya do.
A majority of the people in this population
we are 9th-hour people. You wait until when the child has brought the certificate from Form 4. That's when now we start thinking about
for the money.
School fees for next year when the child is going to university. You are busy selling the car, taking a loan, selling the rad, and at times it can get very desperate. Start building a fund for educating the child right from the outset. In fact, prudent parents will start putting funds together when the child is born, because at that point you got approximately 18 years to prepare.
Yeah,
when the child is born, you got 18 years. But if you wait until the child is 5 years, you have 13 years. If you wait until the child is 10 years, you have about 8 years. The more you wait, the higher will be the pressure.
Yeah, that is
because the goal remains the same. And some of the parents have been forced to compromise on the kind of education they wanted to give their children only because you planned late.
Yeah.
You had a chance to take this child to UK. You had a chance to plan for South Africa. You had a chance to plan for Canada.
Yes.
But now you have to compromise because your current financial state does not allow the kind of spend that would take the child to the diaspora or international universities.
That is true.
I'm talking about medium-term goals. Goals that you must accomplish in the next 5 years minimum, but by age of 50. Ensure to align your goals with your cash flow.
Okay.
I see people buying new cars at a time they can't afford.
Yeah.
And that
Like facilities.
one facility distorts and disorganizes everything in the family. That because you bought a car, you are struggling to pay rent. Because you bought a car, you can no longer pay your bills.
Yes.
Because you bought a car, you can no longer pay the SACO loans.
That
Out
is
of
true.
get that much disorganized.
Yeah.
So in the medium term, you must be very, very intentional. Whenever you spending, your spending must align with your cash flow. Manage your lifestyle expenses
Oh, yes.
and avoid getting into unnecessary lifestyle debts.
Yeah.
That's a medium term space. And I've said part of what you do in the medium term is building a fund for educating your children, building a fund that will buy for your house, building a fund that will build for your house, building a fund that will start for your business. Those things that you must do by that age of 50. Now, let's talk about the remaining 30%. It's for your long-term retirement investment. My brother, every single day you wake up, you are a step closer to retirement.
Sure.
It doesn't matter how young you are.
That is true.
The truth is, every day we wake up, you are a step closer to retirement.
Yes.
I might be closer to retirement than you, but you also headed there.
You're headed there.
I one time laughed at my father when he was 55 years. I thought he was a very old man. Now, that's where I am.
Yeah.
Okay? I thought I would never get 55.
It looked like too far away.
Yes. Today, I'm getting to 55.
Yeah.
Now, let me tell you something. You need to plan for that old age. Today, you have the physical energy to do the things that you must do.
Yes.
But do you have a guarantee of the same physical energy at 60, 65?
Not at all.
Some people at 65 will be having terminal illnesses.
Yeah.
Some people at 65 will be having back problems. They can't even walk. Some people at 65, they'll be on wheelchair. Some people at 65, they'll be battling terminal illnesses. So what we're trying to say here is that you need to be fully equipped in terms of your cash flow, that you have built enough savings to take care of old age.
Yeah.
The children that you have today are not necessarily going to take care of your financial baggage.
The black tax.
They're taking care of themselves, not you.
Yeah.
So you must be very intentional in building a fund that will actually be able to support your agenda that time, that can still be able to pay your bills. If it is water bills, you can pay. If it's fueling your car, that you can do. If it's medical bills, you can pay. If it's renewing your medical cover, that you can do.
Yes.
Don't sit back, spend, and hope that things are going to be nice that time.
Yeah.
You may not have the energy and
To
the
correct
risk
those mistakes.
appetite
Yeah.
to do the things that you can potentially do today.
Yeah.
That time.
Yes.
Build a fund for retirement. And I want to tell you, my brother, if there's ever been a neglected subject in Kenya, it is retirement planning.
True.
People are getting to retirement unprepared. People are getting to retirement with excuses, apologies, and blame games.
Yeah.
You are blaming everyone for your situation.
That
You
my
are not trying to
parents.
redeem yourself. You just chose to ignore things.
Yeah, sure.
So I'm telling people now to start becoming a bit more intentional. Think about the kind of retirement you want. And look at how many years do you have between now and then. And organize your finances that you're not spending everything today.
Yes.
Leave some of that which you're making today to go into savings for future. So that when you get there, if today as an old man you are unwell and you want to go to hospital and you're telling your son, my car has enough fuel. It has enough. It has insurance on it on the screen. I just want somebody who has a license to drive me to the hospital to see my doctor.
That's easy.
And you're telling your son, even the bills I have the money to pay.
Yeah.
I've got my debit cards. I have got my credit cards.
Yes.
You're not telling your son that he's going to pay.
Yes.
Everyone will be willing to take you.
Yeah.
But make a mistake. Tell your children that this car doesn't have fuel. It looks like this car does not even have insurance. Looks like I don't even have money to pay the bills. I'm looking for somebody who can come and help me. They'll not be available.
Nobody will be available.
No one is going to be available.
Yeah. Yeah.
So please, if you love yourself, you must start investing for retirement.
Yeah.
If there's any gospel that I try to preach every single day, it's about sensitizing people, men and women, to take retirement planning seriously.
Very serious. Sure.
Yes. And for me, you don't even have to tell me that you love yourself. The way you're managing your money, the way you're dealing with your money issues, is enough to tell me if you really care and love yourself.
Yeah.
If you're just carelessly spending, it tells you that you no longer matter to your life. Your life doesn't matter to you. But if you're very, very cautious on how you spend your money,
Yes.
and you don't just want to spend without thinking through what you're spending on, and you have complete regard of your future, that tells me that you love yourself.
Okay. So now, what are these non-negotiables when it comes to financial discipline?
I think for me, based on the first step that I've talked about,
Yes.
the first thing that is completely non-negotiable is your emergency fund.
Emergency funding.
That don't negotiate.
Yes.
Because an emergency can come anytime. And you don't want to be giving people trouble when an emergency comes your way. And an emergency can be for as simple as somebody has snatched your phone in the street.
True.
And you need to, how long can you stay without a phone today?
Today you can't.
You can't.
Even
you
Katululu
need to
is-
replace that. You need to replace that phone like immediately.
Immediately, yes.
Do you really need to cause drama to everyone here because your phone was lost? If your phone has been lost and you have
Yes.
an emergency fund, you quickly redeem money from emergency account, buy the phone and carry on with your life.
Yeah.
So an emergency account for me is important. The second thing that is also not negotiable is a budget.
Yeah. First of all, on that emergency fund,
Yeah.
do you have a technical amount, maybe a tentative amount, a makeshift that somebody would consider that one as emergency fund?
Different people are on different levels of the financial trajectory.
Yes.
At all stages, ensure that you build a threshold of 3 to 6 times of your monthly financial requirements.
Okay.
Repeat that. Let's say,
Repeat
my
that.
brother, you need 100,000 shillings every month as a bare bone budget. You know what's a
So
bare bone
if
budget?
you earn 100,000,
No.
let's say
I'm
for
saying
example,
you need 100,000 shillings. And this 100,000 shillings is your bare bone budget. So what's a bare bone budget? Is the minimum amount of money that you need for sustenance. Just for you to live normal, not doing anything exaggerated,
yes,
take care of your bills,
yes,
have food on the table. The basic minimum is at
need 100,000.
It's called your bare bone budget.
yes,
Based on your bare bone budget, you need to build a threshold of 3 to 6 times of your bare bone budget. That if you normally require 100,000 shillings for sustenance, your emergency account should have at the minimum 3 times of that, which is like 300,000. You
Yes.
can stretch that to as high as 6 times of it, which is about 600,000.
Yes.
So with an emergency account of between 300 to 600,
yes,
you have a good ground in terms of emergencies. At any
Yes.
one stage, you can be able to do the emergencies without disturbing them, even if you lost your job.
yes,
That you have got enough to sustain your obligations for a minimum of 3 months, maximum of 6 months, or thereabout.
yes,
But where are people? As soon as the job is lost, we normally start borrowing the next month.
yeah,
Look at COVID.
Yes.
Some people, only when we were hit by COVID,
Yes.
in less than 2 weeks, they were borrowing. Then you're
Yeah.
asking yourself, really, has this guy even exhausted what he should have saved? They
Yes.
had nothing in their savings.
Yes.
And this at times even affects the rich men and women. You are living very high standard of life, but you are not putting structures in place to sustain you there in case of an emergency. So when emergency comes, it throws you down.
it takes you
So
down.
in emergency account, 3 to 6 times of your monthly financial requirements, and the money must be accessible all the times, whether in the night, during the day, and you must also ensure it's in a safe environment. You do not want to put money in a money market or in an emergency account where the fund performance is affected by the market movement. That
Yeah.
yesterday you had 200,000, today is at 195. You don't want
Yeah,
such an
you don't
environment
want such
for
one, yeah.
emergency.
Yeah.
An emergency account should actually be safe all the time.
Yeah,
And that's why most of the people prefer to put their money in instruments that trade with the government. Short-term instruments.
The T-bills.
The likes of T-bills, treasury bonds, debentures, commercial papers, those things. Where the interest is every day. We call it
Yes.
daily yield. And you can redeem your money anytime you want. You can top up the account anytime you want. The fund managers that are there will ensure accessibility into your funds all the time.
yes,
And in a money market environment, if I could also mention here, is a very secured environment because in a money market environment, there are 4 entities. The first entity is called a custodian. The second entity is called a fund manager. The third entity is called a trustee. And the final entity is called an auditor. Let me talk about each of these briefly. A custodian receives money for investment purposes. And a fund manager gives investment direction. A trustee ensures that the interest of the investors is prioritized all the time. And an auditor ensures financial compliance. You, the investor, provide cash for investment purposes. That I can tell you. That money markets are regulated by Capital Markets Authority through an act of parliament. And that alone gives you the security that you need.
yes.
You don't have to worry. So when you lock your money in a money market, you can be sure at all times that money is accessible and it is secure.
Yeah,
Okay?
yes, yes.
I've talked about the budget as the second tool that is a non-negotiable. Non-negotiable. Because now with the budget, what happens is that you'll be able to direct where your money will go and for what kind of priorities. You do not spend beyond your means. And at all stages, as you spend cognizance of what you need as security for the medium and long term. You get? Let me talk about another instrument that is also non-negotiable, which a lot of people undermine or ignore. Succession planning.
Okay.
Succession planning. How many dramas are lawyers having in court? Because people died intestate. We don't know who to give the wealth that has been left behind.
Or even
After
unclaimed
death of the
funds.
guy, so many other children emerge. And they're able to prove that they are children of the dead. And then drama starts there.
deceased, yeah.
15 years down the line, the legitimate beneficiaries are yet to inherit. Because of the dramas around succession formula
the
and
disputes,
succession, who is actually supposed to be inheriting. You get?
I get that.
Let me also talk about something else. Risk management structure.
Okay.
Every day,
It's part of the non-negotiables?
there are risks.
Okay.
Every day, there are risks. But a lot of people have dependents. Maybe my brother, you already have a young family. Maybe you have a child. Maybe you have a spouse. Maybe you have some elder parents that you're supporting.
Yes.
Every day there are enough risks. Let me tell you, for avoidance of doubt.
Yes.
There are people who woke up this morning, they were in perfect health, they had the money, they had families, they had good jobs, but as we speak right now, they're in mortuaries.
Very true.
There are people who are dying in the next 1 hour. There are people who die in the next 3 hours. There are people who are dying tonight. There are people who die tomorrow. We don't know our date. Because this is a risk. Can you look at the people that you support and ask yourself a simple question? Can that person survive in my absence or absence of my income? If that person cannot survive in your absence or absence of your income, can you put a cushion in place
You empower
to cover
them
your
all.
life? So that if in my absence, a benefit is paid out so that that person that was depending on me can carry on with life. If it's child,
okay.
then there will still be money for school fees and food. You don't die with and then make the child die as well. Why should your death affect the child? Why should the child die because you died?
Yeah.
Provide when you are alive so that when you are not there, that person that was depending on you call his own. There's disability. My brother, today, if you are bride, you most likely will not be seated where you're seated. If you're on a wheelchair, most likely not be seated where you're seated. And that being a risk, what plans have you put in place to cushion you that in case of that kind of a risk, I will still be able to provide to my dependents?
Okay.
Critical illness.
Okay.
A lot of people right now, my friends, are suffering from terminal illnesses. Cancer is slowly becoming a monster. How do you deal with such a risk? Are you still hoping to invite people for fundraising? Let me tell you in advance. Kenyans are tired of fundraising. You put them in a WhatsApp group. Within minutes, some of them have jumped out of the group.
They've left immediately
They
sometimes.
have left. They don't even say a word.
Yeah.
Others have learned a new technique of staying in the group. They never say a word. They never contribute.
Yeah.
So what you're telling the people out there, take personal responsibility.
Yes.
This one is a risk. Cover it. Even if you get the most basic medical insurance, it is important for you. The most basic is good for you. There are even some companies that are charging per month. There are some that are even charging per week. There are some that are even charging per day. If you can be able to get yourself a small medical coverage for yourself and even your immediate family, it will do you a lot of good. Because the big risk ahead of us, that is you are diagnosed with a terminal illness or some illness of some sort, companies don't take stories anymore. Banks also don't take trauma as a mode of payment. You go to a hospital or a bank, they need security, they need their money back from you.
Yes.
So you need to ensure that at all times you are properly
Covered.
equipped.
Yeah.
Then I also want to talk about your long-term goals. Don't always think about today and tomorrow. Can you have a view of your long-term goals? Have a long-term trajectory. Even sit down and define who you want to be 15 years from now. If you're 40 years and you're going to retire at 60, where are you going to retire? Is it up country or in Nairobi? And what does it take to be up country? What does it take to be in Nairobi?
Yeah, you need to evaluate all that.
You need to have clarity.
Yes.
Don't just sit back and wait to be surprised by a monster that you never expected.
Yeah.
Plan. Planning is very, very important.
Yeah.
Money respects planning.
Yes.
And that's what I said from the beginning. So I think these are some of the things that are non-negotiable when it comes to financial planning.
Yeah, sure. So with all these non-negotiables in place, what advice will you give to this young generation and the young people who are getting employed today, those who actually are venturing into business, etc.? What kind of an advice would you want to maybe give them?
I always say that the baboon that beds during the time of the weed is the one that survived the storm. The baboon that beds during the time of the weed is the one that survives the storm.
Yeah.
You, at whatever stage
So the
of
one
life
that
you are,
remains static like this one hardly will start.
it will be wild.
Yeah.
At whatever stage of life you are,
Yes.
can you try to allow yourself into financial planning? Can you upskill yourself? Because when it comes to financial planning, the biggest risk is not investing. It is not investing in financial education. Can you first of all get financial skills so that you know how to manage your money?
Yes.
That's the first point. The thing, can you take advantage of the age that you have because you got enough years ahead of you to compound that which you start putting aside now? Because a lot of people just invest the money. They never invest the time. You need to invest the two for success. So if you are 30 years and you want to retire at 60, you got all 30 years to make an impact. But if somebody is 50 years and wants to retire at 60, they have a relatively shorter time
A very short
to make
time
an
to put
impact.
things together. Yes.
So if you are young, can you start early? Financial planning is about when you start. It's not about how much you invest. In fact, a scenario has been given where some 3 young men came together and they agreed to start investing for retirement. I wanted to hear this, very, very interesting. They agreed to invest for retirement and they defined the retirement age to be 60. They also went ahead, because they work in the same organization,
Yes.
they agreed that if all of us can start investing just 100,000 shillings every year into this retirement fund, by the age of 60, we'll have a sizable fund that can be able to secure our retirement. That time, they were between 28 and 29 years. I'm telling you, they agreed also that retirement was an individual responsibility.
They agreed on that.
Unfortunately, there were 3 of them. Unfortunately, only one of them started investing at the age of 30. That guy invested from the age of 30 to 40. And every year he was investing 100,000. In those 10 years, he put together 1 million shillings. That million shillings was compounded all the way to the 60th birthday. The guy got 11.7 million shillings. The second guy wasted 10 years. He started investing at the age of 41. However, he invested up to the age of 60. In those 20 years, at a rate of 100,000 shillings per year, he invested 2 million. This 2 million shillings was compounded to the 60th birthday. He got 6.3 million. The third character of a procrastinated. He started investing at the age of 51 at a rate of 100,000 shillings per year. In those 10 years, he managed to put together 1 million, which was compounded to 1.7. Now, let's look at these 3 guys. The first, especially the first and the third, they both invested 1 million shillings, but look at the outcome of the first one was 11.7.
Yes.
The third one, 1.7. Why the big difference? And they invested the same amount of money. Because when it comes to financial planning, it is not about how much you invest. It's about when you start investing.
Oh, okay.
For that reason, I say procrastination is a monster. You need to invest, then wait.
Yes.
Do not wait to invest.
Yes.
That's very, very important. That's point number 2 that I wanted to say. The other thing is to ensure that whatever you're doing with your money right now, you can sustain it even in terms of disruption. If you can't sustain that lifestyle, then you need to change the way the manner in which you're handling your money. That every Friday you are always eating out. Every Friday you're with your friends drinking. Every weekend you are having a getaway, a drive out of this town. If that is what you are doing now, and you can't be able to sustain it if your income was stopped, then you need to immediately revise on the way you manage your money. Whatever you do with your money now, ensure it can be sustained even in the event of disruption. And as such, can you build a passive income? Because in the event of disruption, the passive income will allow you to maintain the same lifestyle, even when the income has been cut off. Unfortunately, a lot of the young people, they spend as though there are no disruptions. You wake up one day, you've lost your job. You wake up one day, you've been made redundant. What happens next? If you are not very cautious about your investments, your emergencies, your lifestyle, then you'll be thrown totally out of your balance. So it is important that you can think through from the onset.
Yeah.
There's something else I also want to say here, that you must ensure at all times that lifestyle expenses are controlled. There are people who borrow 100,000 shillings over the weekend. They borrow 200,000 shillings over the weekend. I did talk about 25, 50, 25, and I said the last 25% of your income is supposed to be for lifestyle. And that is handling very many expenses. One of them could be black tax, if there are people you are supporting. The other one could be, upgrading of your gadgets. When you talk about iPhone 18 Pro Max, you don't buy that with the money that is meant to be going to savings and investment. No, you buy it from money that is in the lifestyle account.
Yeah.
When you decide to upgrade your car, you don't stop investing so that you can buy the car. No, the money for the car should come from lifestyle account.
Yeah.
Tithing in church for those that are Christians should not stop you from investing. That money is coming from lifestyle account. When you are eating out with friends, that money should not stop you from investing because it should be coming from lifestyle account.
Yeah.
So that lifestyle account ensure you don't spend more than 25% of your regular income on it. The reason why most of the people are in very shaky financial status right now is because when money comes in, they only focus on two elements: your needs and lifestyle. You have nothing for savings and investment.
Yes.
So can you start by having that discipline to adopt a budget formula that helps you take care of all the aspects that are essential in your life?
Yes.
Including investment. Yes.
So now I would really interested in actually knowing how do you start a financial discipline that journeys towards a generational wealth?
No one has the monopoly of information. It will be important that you decide to work with an accountability partner and a financial coach, financial advisor, somebody who can guide you on matters investments.
Sure.
This is the person who will tell you that from the income you are making, this should be your priorities at this stage. As you progress, this should be your priorities in the next level.
Yes.
As you progress, this should be what you'll be focusing on in the third stage. Remember, I talked about the 4 steps of an ideal financial planning roadmap.
Yes.
As you're accumulating the money, you're making the money, and you start accumulating.
Yes.
A financial advisor is needed there to guide you as you accumulate. Where do you accumulate this money? Is it in a bank account? Is it in a money market? Is it in a circle? Do I keep the money in the house? You need someone to guide you based on your risk appetite and based on the income pattern. Next element is that as you accumulate this money, that you now start directing it into an environment where it can appreciate over time. So what is that environment that you can take your money, you can direct your money so that it appreciates? Is it a high risk option? Is it a modest risk option? Is it a low risk option? Depending again on what the goals that you want to accomplish, the person will be able to guide you appropriately. Then as we navigate, you start diversifying. What investment classes do we have? Where must I invest my money? Is it in stocks? Is it in shares? Is it in bonds? Is it in money market?
Yes.
Is it in land? Is it in construction investment? Is it in a pension? Your financial advisor would actually be able to guide you again. When you do that, you have now diversified. You now need to secure. What if I'm diagnosed with an illness? What if I died? What if I became disabled?
Yes.
You're now starting thinking about risk management. And again, the financial advisor will be able to guide you. Do you need a term life?
Yes.
Do you need a whole life? Do you need to have a critical illness cover? Do you need just to have a business insurance? They will guide you on the risk options, the risk mitigation options that you have to be able to secure your portfolio. Then as you progress to the next status, very, very importantly, you now might engage another expert, a legal expert, to help you in distribution, which is, as I said, is called the succession planning. That's a legal process. And that will need a legal expert. And a lot of the people that have been serving up to date, I always tell them that their financial plan is not complete until they have sat with their legal experts for guidance on succession matters. Do you need to do a will? Do you need to do a trust? What factors must you consider when going for either of these? That's now a conversation for a legal expert. They should be able to guide you. The moment you are totally involved in the entire process and you're working with the experts, you can be sure to achieve your long-term agenda. The biggest problem with a lot of people, they don't want advice from anyone. You think you have all the information that you need. It is when you fail that you start looking for remedy. That's when you start looking for experts that should have guided you. I want to ask you this question.
Sure.
I want to ask you this question. At what point do you need to see a doctor?
You just should do some regular checkup. Okay. Maybe.
At least you got some idea. You need to see a doctor when you are medically okay, so that they can check and confirm that you are actually okay. But the bulk of people see doctors when they are very sick. In fact, some of them see doctors when they're not even talking. You can't even be able to explain your problem. You can't even be able to explain your condition. For men, we never got to see doctors. We are taken. Men never got to see doctors. They are taken. On average. Most of the men are taken to see doctors. They'll never go to see the doctor.
They never acknowledge that now I'm unwell.
And when you are taken there by your spouse or by your family, the family is struggling to explain your illness. Because yesterday you complained about mild headache on this side. Maybe the pain has shifted from this side to the hip or to the ribs. You see? So in the process, you're going to be misdiagnosed.
Yeah, sure.
Because the doctor is not getting accurate information. Similarly, don't come to see a financial advisor when you are being auctioned. Don't come to see a financial doctor when you're in a mess. I don't know people that come to see me.
Yes.
2 days ago, I had somebody calling me and is asking for expert guidance on retirement. The guy is 59 years old. Then I asked him, how many more years do you have to retirement? He said, I'm retiring next year, March. So I'm asking myself, where can I help you? Where can I help you?
And they ask the advice for how to.
The only thing I told him, when you get to retirement fund, which I believe you've intentionally built, call me, then I'll be able to direct you where you can place that money so that you can start living on that profit. Then the guy told me that, no, I don't have that yet. He does not have any pension. He's retiring next year. He's hoping that I can be able to come up with a formula that multiplies the money. I don't have a formula that multiplies the money. Money is never multiplied. Money grows. It has to go through some process. There are some steps.
Sure.
Let me talk about financial independence, by the way, before I forget this, because it's important.
Yes.
Because a lot of us, every time we talk about financial independence, what is financial independence? It's a state of having enough passive income that can sufficiently meet your current expenses without the need to actively work. Right now, my brother, you are doing active working. You are actively working. Every day you come here, you do stuff that matters to make your income.
Yes.
There'll come a day there'll come a time you will not come here. You'll be staying in the house. And your sustenance will be supported by the investments that you did when you're in your productive phase.
That is true.
Let's call that passive income. A lot of people don't have passive income. They only rely on active income. When you're financially dependent, you do not have to work for the money. The money works for you. It is good that you can consider a few steps that will get you to financial independence. And I want to mention just a few. The first step
Go ahead.
is that if you talk about goals, ensure they are clear and they are smart. Smart goals are specific, measurable, achievable, realistic, and the time bound.
Yes.
That's point number one. Number two, do not allow yourself to spend even a shilling outside the budget. Anything you have to spend, can you go through the budget? Is it in the budget? If it is eating out, if it's going for a party, if it's going to Naivasha, you guys call it Naivasha. If it's not in your budget, don't go.
Yes, it has to be the budget.
It has to be the budget. Number three, this life has got a lot of financial disruptions.
Yes.
You need to be properly equipped for emergencies. That when emergency comes, you got sufficient coverage that can address the emergency. Your emergency is not mine, it's yours.
Yes.
Deal with it.
Yes.
So that becomes your that step. The fourth step, and very important, you start investing.
Yes.
So what is this investing? It is where you intentionally grow your portfolio vertically and horizontally in size. That the 1 million shillings is going to be 1.5 million shillings the next 1 year or 2 years.
Yes.
You are subjecting your money to environment where it appreciates over time.
Yes.
The next element, diversify the scope of investment.
Yes.
When you invest, don't put all your eggs in one basket.
Yes.
The Bible is very clear. 7 to 8 streams of income. The question is, do you presently have 7 to 8 streams of income?
7 to 8 streams of income.
7 to 8 streams of income.
That's
a lot of people are on one. A lot of people only have one stream.
Yes.
That if that is disrupted, you are thrown to the dogs. You have no way to survive.
Yeah.
So you have to diversify. Let me talk about the other one.
But 7.
Sure. 7 to 8. It's in the Bible. It's in Ecclesiastes.
It's okay. Go ahead.
Then the next element is to do risk management. Because I've said there are enough risks. How can you ensure that your portfolio will live beyond you to take care of your children and the grandchildren? Let me tell you, God's desire was for humankind to build enough resources for themselves, for their children and their grandchildren. And it's very, very clear. A wise man leaveth inheritance for his children's children. Most of the children today are inheriting excuses. They're inheriting apologies. They're inheriting stories. They're not inheriting any assets. Because the parents were never intentional from the onset to start putting stuff together for themselves, children and grandchildren. In fact, the grandchildren will not even know about you. Because if there was nothing left for them, how will they remember you? How will they remember you? Let me talk about the next step. Succession planning. Succession planning. That which you are building now, you're not going to die with it.
Yeah. You leave it behind.
When you die, you're only going to be buried in one suit. They will not even put a watch. You don't need it.
Yeah.
Time doesn't matter wherever you're going. You don't even need the specs.
Yeah, you don't.
Even this jewelry that you have all over the place,
these
those gold chains, you don't need.
These will be taken away, no matter how expensive
you'll be very lucky if they put you on shoes or shoes on you. You'll be very, very lucky. And socks.
But you still don't need it.
You don't even need.
Yes.
So what you're saying that all these that you build together over the years, how is it going to be transferred to your children and grandchildren? That's where succession comes in.
Yes.
I talk about distribution. The process needs to be timeless and legitimate. If you don't do it yourself, you can be sure those that are left behind will fight.
If you don't do it, the
You don't
people
do
you
it
leave
properly.
behind
You
will
don't
be
do
in
it properly.
dispute.
They'll dispute and they'll fight.
Yeah.
You've left a car in the compound. Let's call that car a Mercedes.
Yes.
You've got a wife here and you've got 2 sons. So
everybody's claiming it now.
Who is going to have ownership of that car? Is it your wife or is it your sons? And if it's your sons,
Even
is
the
it a
sons
bigger one
will-
or is it the younger one? They start fighting.
Yeah.
Assuming there are 3 cars, even. I mean, 2 cars, but there are 3 people. They can't even agree who is going to be using which car.
Even if there are 3 and there are 3 people,
Yes.
they still cannot agree on which one goes to who.
Because they want equality. That you've left 3 apartments.
Yes.
One is in Kisuru. The other is in Syokimau.
Yeah.
The other is in Kitengera. They start looking at which one has a higher value than the other.
Yeah.
And of course, everyone wants the one that has higher value. They start fighting. Succession planning is very, very critical. Very, 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 extremely critical. So these are some of the steps that you have to intentionally deal with when you're alive. And especially if you wanted financial independence. As I've said, when you're financially independent, you don't have to work for the money. The money works for you. Ensure that as you get to old age, you've built a fund that can generate a minimum of 85% of the income you'll be earning last.
Yes.
We call that income replacement ratio. If my brother, you're earning 1 million shillings at the point of retirement,
Yes.
ensure that at the point you retire, your passive income at the minimum is going to be 850,000. If you don't do that,
Yes.
you settle on 10% income replacement ratio. That you're earning 1 million, now you're settling on 100,000 shillings.
Yes.
You'll have to downgrade your lifestyle.
You have to.
You used to eat at Java and KFC.
Yes.
Now can you start knowing where Domas and Kwasi come from? You used to fly all places in this world business class.
Yes.
My brother, can you know how much it costs
Economy
to go
for-
SGR?
Yeah, SGR.
SGR. This is not an economy there.
Yeah.
SGR. You used to go on these exotic corridors every so often. Please know the location of Uhuru Park. You can't go beyond Uhuru Park. These are the things. You are always a guy of iPhone.
Yes.
Please, my friend. Mulikamuzi becomes
Not even an Android.
yes, not even Android. Now it is Mulikamuzi. You had a gathering in your compound.
Yes.
You become a pedestrian.
Yeah.
You can't even fuel a Vitz.
You can't.
You now start walking and leaving the car in the compound. You cannot even renew insurances. You can't even buy the tires.
Yes.
Look, all your friends will abandon you. Let me tell you, my brother, whether you are born again or not, no one wants a broke person.
Nobody. Not at all.
No one wants a broke person.
Yes.
The moment you start calling people that you're borrowing money, even your closest friends, they'll abandon you. So ensure at all stages you are adequately equipped. You got what you need. You are not relying on anyone. You got what you need. All your needs can be met by your resources. There's no one that is going to come and take charge or take care of some of your obligations. Take care of yourself.
Yeah.
This is about financial planning, which, as I said from the onset, 97% of people are financially sick. They never sit to think about all these things.
Yes.
They hope that life is going to treat them nicely.
Yeah.
You put in garbage, you get out garbage.
Yes.
If you're not investing, don't sit and hope that money will come your way. Money goes where there is more.
Yes.
Money goes where there is more.
Where
if you have
there's
no
more
money, even the little you have is going to be taken away.
Very, very true. Absolutely. So now, I just want you to give us a parting shot. Even though this final statement looks more like the parting shot, we still need a parting shot from that. But there's one comic question that I will just ask you. I was seated here with one of these famous artists here called DNA Banjuka. You might be knowing him.
I know him.
Yeah, so he's a very great friend of mine. He's a great person, actually. And we were talking about these financial things, and he understands of my background in banking. And he asked me a question that even without my background in banking, I was unable to answer him. He asked me, why is it that banks don't have toilets? Why is it that we don't have yet any other organization with hospitality, etc., will have at least a washroom for customers? Why don't
I've actually not thought about it. Sincerely, I have not
So I was unable to answer it. I tried moving around, but I think he caught me.
I think you take care of your problems. You take care of your problems. They're not taking care of those problems.
Yes.
You take care of your be independent. Now, in terms of parting shot, let me tell you a couple of things, my brother.
Yes, sure.
And the first one is that, my brother, even if you are the tallest grandfather,
Yes.
you'll have to do your own growing. You can never inherit height.
Yes.
You can't inherit height. You have to do your own growing. And that
That's
has
deep.
a lot of meaning even in financial planning. I want to tell you the second thing is that if you are not planning, be sure poverty is planning for you. And the plan poverty is having for you is not a good plan. Thirdly, if you want to remove your greatest obstacle,
Yes.
remember that you're the obstacle yourself.
Okay.
Because the biggest battles when it comes to financial planning are fought from within.
So you move yourself first.
Yes. The other one is obstacles and excuses are what you see when you take your eyes off the goal.
Okay.
Obstacles and excuses are what you see when you take your eyes off the goal.
Okay.
So I want to tell you that your attitude is very, very critical. How you look at things in this life. If you are a pessimist, it doesn't matter the effort. You will not have a turnaround financially.
Yeah.
You need to have a bit of positivity because money is attracted by positivity as well. You have to assess your financial discipline. You have to start small.
You have to.
You have to think big. Start small, but you have to start now. You have to think big. You start small, but you have to start now.
Now, yes.
There's no place for procrastination. There's no place for procrastination, my brother.
Yes.
So what I want to tell you is that the moment you allow yourself to have the right level of discipline, you have got clarity of your goals.
Yes.
And you are willing to make the necessary sacrifice. Because we live in a world of trade-off. You'll be able to achieve your ultimate agenda. It doesn't matter how poor you sound or you look today. If you're having the right money habits every single day, that will inform the behavior and character that you're going to have in the next few years. And that a lot of times shapes your financial success.
You're sure.
So for me, a lot of those people that keep complaining, I don't have money to invest. No one has money to invest. We only make a sacrifice.
Nobody has.
We never talk about a broke amount to sacrifice. To invest.
Yes.
We talk about a percentage.
Okay.
My brother, you're earning 100,000 shillings. Me, I'm earning 50,000 shillings. Let me just invest 25%. You invest 25%.
Yeah, sure.
You see, work with a percentage. Don't work with a broke amount. Because if we work with a broke amount, you might always feel like you've not reached that level yet.
Yes.
You might always feel you're not in that level yet. So I think for me, it is important that we can cultivate the right habits from the onset.
Okay.
Don't wait to invest. Invest, then wait.
Yes.
Don't wait to invest.
Yes.
Invest, then wait.
Yeah.
And
sure.
at all stages of your life, work with a financial advisor if you really want to achieve anything financially.
Okay.
Work with a financial advisor. They will help you to know what to do at what stage.
Yes.
And at all stages, you'll be putting your best foot forward.
Yes.
You get?
Yes.
Remember what I've said as I close? The baboon that beds during the time of the weed is the one that survives the storm.
Yeah.
If you respect your financial planning, stop procrastinating.
Yeah.
Take action. You'll be saving your future. You'll be saving the future of your children. And you'll be putting your retirement into right perspective.
Yeah. Yeah. So I think as we are closing down, I want you to demystify just one thing that is actually coming up. That financial therapy is actually very, very expensive and it's a preserve of the few, the elite, the people who have the money. Demystify that.
Why are we talking about financial therapy? Because people are financially sick.
Yes. Okay, no, that one and including, you say that we work with a financial advisor.
Yes.
Yes, even that, working with a financial advisor comes at a cost, probably.
Let me tell you what. Do you know why the costs come in?
Yes.
It is because you've procrastinated.
Yes.
When you've lost options, that's when you come in. You need to engage with a financial advisor from the onset. Not when things have gone wrong.
Okay.
Engage with them from the onset. It becomes easier to do things correctly the first time.
Yes.
Instead of always making a mistake and then trying to rectify. Rectifying is very expensive. You are trying to see a financial advisor to help you in budget management because right now you are facing a court order. There is an auctioneer sending you letters. A bank is stressing you. That's a very, very awkward time to be looking for a financial advisor. Look for a financial advisor when things are okay so that they show you how to keep on that track.
Yes.
That don't make assumptions that are not necessary or that would cost your business or will cost you your financial stability at a later stage in life.